There is a ghost in your portfolio. It's an invisible force that whispers in your ear every time you log in to check your account. It's not the market, it's not the Federal Reserve, and it's not the CEO of the company you've invested in. It's a ghost of the past. It's the ghost of the price you paid. This specter follows you, haunting every decision you make. When a stock is down, it whispers, "Just wait until you get back to even. Don't take a loss. Don't admit you were wrong." And when a stock is up, it screams, "Sell now! You've doubled your money! Don't be greedy! Lock it in before it disappears!" Both of these voices, the whisper of hope and the scream of fear, are lying to you. They are the twin sirens of emotional investing, and they are leading your financial ship directly into the rocks. They are the most dangerous emotions in investing, and they are born from a single, simple number, your purchase price. Today, we are going to perform an exorcism. We are going to banish this ghost from your financial life forever, because we are going to arm you with a mental model so powerful, so clear, and so profoundly rational that it has been the bedrock of one of the greatest fortunes ever built. This is the principle that Warren Buffett uses to manage hundreds of billions of dollars, and it is brutally, beautifully simple. A stock does not know you own it. The price you paid is a historical fact, a sunk cost, a memory. It has absolutely zero bearing on that company's future earnings, its competitive position, or its stock price tomorrow. Your emotional attachment is a liability, not an asset. By clinging to the past, you are sacrificing your future. The financial transformation you are about to undergo is this. You will learn to evaluate every single stock in your portfolio with fresh, cold, calculating eyes every single day. You will learn to make decisions based only on a company's future prospects and its current valuation, not on its history with you. This isn't just a small tweak to your investment strategy. This is a fundamental rewiring of your financial brain. It is the dividing line between the amateur who hopes and the professional who calculates. It is the secret to cutting your losers without mercy and letting your winners run beyond your wildest dreams. It is the final promise of true, unemotional, rational investing. Our journey begins not with a stock, but with a shoe, specifically the Dexter Shoe Company. To understand the profound danger of being anchored to a price, we must travel back to 1993. Warren Buffett was at the absolute zenith of his power and reputation. He was the Oracle of Omaha, the man who could do no wrong. Berkshire Hathaway was a juggernaut, and its stock was one of the most coveted financial assets on the planet. Buffett was on the hunt for what he called elephants, massive businesses he could acquire to put Berkshire's ever-growing mountain of cash to work. He found what he thought was a perfect target in Dexter Shoe, a rugged American-made footwear company based in Maine. On the surface, it had all the Buffett hallmarks. It had a long history, founded in 1957. It had a solid brand, known for quality. And it had a track record of consistent profitability. It seemed like a durable, simple American success story. Buffett was so confident that he made a decision he would later come to deeply regret. Instead of paying cash for the company, he decided to buy it with Berkshire Hathaway stock. He paid 203 shares of Berkshire A, which at the time were valued at approximately $433 million. Now pause here. This is the moment the anchor was dropped. The price was set. $433 million. For Buffett and the shareholders of Berkshire, this was the number that would forever be associated with Dexter Shoe. It was the mark on the map, the entry point on the ledger. And for a while, everything seemed fine. But something was happening in the world of global trade that Buffett, by his own admission, failed to fully appreciate. The competitive landscape for footwear was shifting beneath his feet. Low-cost manufacturing from overseas was becoming a tidal wave, and Dexter, with its proud American-made heritage, was standing on the beach. Their cost structure was simply too high to compete. Their profits began to erode. Then they vanished. Then the losses began to mount. The durable competitive moat that Buffett thought he was buying turned out to be a shallow ditch, easily crossed by foreign competitors. The business, in essence, went to zero. The entire $433 million investment was a complete write-off. A painful public mistake for the world's greatest investor. But here is where the story becomes a masterclass in the tyranny of the purchase price. The true cost of the Dexter shoe deal was not $433 million. That was just the anchor, the historical number on a piece of paper. The true catastrophic cost was hidden in the currency he used to pay for it, those 203 shares of Berkshire Hathaway stock. As Dexter's shoe crumbled to worthlessness, Berkshire Hathaway's value continued to soar. Those shares, which were worth $433 million in 1993, would, over the next couple of decades, become worth billions. By the late 2010s, that same block of stock was worth over $6 billion. So what was the real cost of Dexter's shoe? Was it the $433 million price tag from 1993? Or was it the $6 billion in future value that Berkshire shareholders gave up? Value that was exchanged for a business that ultimately became worthless? The answer is obvious. The real cost was the opportunity cost, what that capital, in this case, Berkshire stock, could have become. This story is the ultimate illustration of our first pillar, the anchor of the past. The $433 million price tag became an anchor, chaining the narrative of the investment to a single, irrelevant historical data point. Most investors make this mistake on a smaller scale every single day. They buy a stock at $100, it drops to $70, they anchor to $100. Their entire mental energy becomes focused on getting back to $100. They buy a stock at $50, it rises to $100. They anchor to $50, thinking, wow, a 100% return, I should lock that in. In both cases, the anchor of the purchase price is dictating the decision, completely blinding the investor to the only question that actually matters. What is this business worth today, and what are its prospects for the future? Buffett's Dexter shoe mistake is so powerful because it reveals the absurdity of this anchoring. He was anchored to a price, but the underlying value was collapsing. The stock he paid with was a living, breathing asset whose value was exploding. By focusing on the price of the deal, one would miss the multi-billion-dollar catastrophe that was actually unfolding. This tendency to latch on to the first piece of information we receive is a deeply ingrained quirk of the human mind, a cognitive bias known as anchoring. It's one of the most well-documented and powerful forces in behavioral finance and psychology. When you go to buy a car, the first number the salesman throws out, the sticker price, becomes the anchor for the entire negotiation, even if that price is completely arbitrary. Everything that follows is a reaction to that initial anchor. When you're negotiating a salary for a new job, the first number mentioned, whether by you or the employer, sets the gravitational center for the entire conversation. Our brains are wired for efficiency, and anchoring is a mental shortcut. Instead of performing a complex valuation from scratch every single time, we grab the nearest, most convenient number and adjust from there. The problem is that in investing, that first, most convenient number, your purchase price, is often the most useless and misleading piece of data you have. It tells you nothing about the company's current reality. It tells you nothing about its competitive advantages, its management quality, its balance sheet strength, or its growth prospects. It is a piece of trivia from your own personal history, and the market, in its infinite and cold indifference, does not care one bit about your personal history. To break free from this mental prison, you need to adopt a new mental model, a practical blueprint you can apply immediately. We'll call it the price-agnostic ledger. I want you to imagine your portfolio, or better yet, open it on your screen. Now mentally or physically erase two columns, the purchase price column and the total gain/loss column. Get them out of your sight. They are poison. They are the source of the emotional whispers and screams that have been sabotaging your decisions. In their place, I want you to create a new ledger. It has only 4 columns. Column 1, the name of the company. Column 2, the current market price. Column 3, the current total value of your position in that company. Column 4, a single sentence that answers the question, why is owning this business, At this current price, the absolute best use of this amount of capital for my future. This exercise is a powerful act of mental reframing. It forces you to disconnect from the past. It shifts your entire perspective from "how am I doing on this stock" to "is this stock the right thing to do now?" It transforms you from a passive scorekeeper of past decisions into an active, forward-looking capital allocator. The holding you're down 50% on is no longer a loser you need to get back to even on. It is now a lump sum of capital sitting there that must justify its existence against every other investment opportunity in the world. A holding that's up 200% is no longer a huge winner you should cash in. It is a lump sum of capital that must prove it can still generate superior returns compared to the alternatives. This is the mindset of a professional, the mindset of a CEO managing the most important company in the world, You, Incorporated. The vast majority of investors, the 99%, live in the exact opposite reality. They are what we call the price watcher. Their path is the antithesis of this rational approach. The price watcher's entire emotional state is tethered to the green and red numbers on their screen. They open their brokerage app the way a gambler pulls a slot machine lever, hoping for a dopamine hit of green. Their focus isn't on business fundamentals. It's on the daily, hourly, even minute-by-minute fluctuations relative to their entry point. They bought a speculative tech stock at the peak of a bubble for $300 a share. Today, it trades at $60. They are anchored to $300. They refuse to sell, not because they've reanalyzed the business and believe it's a fantastic buy at $60, but because selling would mean crystallizing a massive loss and admitting they made a terrible mistake at $300. Their ego is more invested than their capital. The capital in that stock, which could be repurposed for a productive, growing asset, is held hostage by a ghost. It becomes dead money, a memorial to a past error. This is the path of stagnation, the path of quiet portfolio decay, and it is paved with the cobblestones of anchoring bias. The financial connection here is not abstract, it is brutally mathematically concrete. Let's quantify the damage caused by this anchor. Imagine you have $10,000 invested in a company. Let's call it Stagnant Corp. You bought it a few years ago, and after a brief run-up, it fell, and now it's basically flat. You are anchored to your purchase price, hoping it will do something someday. You are waiting to get back to even plus a little extra. For 5 years you hold this stock, and it goes nowhere. Your $10,000 remains $10,000. Meanwhile, over that same 5-year period, a simple, low-cost S&P 500 index fund doubles in value. The $10,000 you left chained to the anchor of Stagnant Corp could have become $20,000. The financial cost of your emotional attachment wasn't zero. It was $10,000 in pure, unadulterated opportunity cost. That's a new car, a down payment on a rental property, a significant boost to your retirement account. It's real money, vanished into thin air, not because the stock you held went bankrupt, but because it did nothing while the world of asset allocation moved on without it. This is the direct financial consequence of letting the ghost of your purchase price manage your portfolio. It's a slow bleed, a quiet theft of your future wealth. Breaking that anchor isn't just a psychological trick. It is the first, most critical step in proper risk management and the foundation of long-term portfolio growth. It is the beginning of your journey towards financial freedom. If anchoring to the purchase price is the chain, then the psychological prison it holds you in is built from the bricks of the sunk cost fallacy. This leads us to our second pillar, the crippling disease of get-evenitis. This is the irrational desire to hold on to a losing investment, not because of its future prospects, but simply because you've already invested so much time, energy, or, most importantly, money into it. To truly understand this destructive force, we must look at the most formative mistake of Warren Buffett's career, a mistake so profound he later claimed it cost his shareholders $200 billion. The mistake was not Dexter Shoe. It was Berkshire Hathaway itself. Not the global conglomerate we know today, but the original, failing New England textile mill that Buffett bought into in the 1960s. When Buffett first started buying shares in 1962, Berkshire Hathaway was a struggling textile company in a dying American industry. He initially bought it as a classic cigar butt investment, a cheap, ugly company that had one last puff of profit left in it. He thought he could make a quick, small profit and get out. But then, an executive at the company tried to cheat him on a tender offer for his shares. This infuriated Buffett. In a fit of pique, driven by ego and emotion, he did the opposite of what he planned. Instead of selling his shares, he started buying more, aggressively. He bought until he had control of the entire company. And now, he was stuck. He owned a terrible business in a terrible industry. And this is where get-even-itis took hold of the world's greatest investor. For years, he kept pouring good money after bad. He was the captain of a sinking ship, and instead of abandoning it for a faster vessel, he kept trying to patch the holes. He would take the small profits from the dying textile business, and, instead of allocating that capital to wonderful businesses, he would reinvest it back into the textile mill, buying new equipment, trying to make it more efficient. He was emotionally committed. He had invested his capital, his reputation, and his ego into turning this company around. He was trying to get his money back, to prove that his initial, emotional decision to take over the company was the right one. He was suffering from the sunk cost fallacy on a grand scale. Every new dollar he put into the textile machinery was a dollar that could not be invested in companies like American Express or the Washington Post. He finally, painfully, shut down the last of the textile operations in 1985, 2 decades after he took control. He had spent 20 years trying to fix an unfixable business. He later calculated that if he had simply taken the money he poured into the textile business and invested it directly into better insurance companies or other high-quality assets from the start, the compounded value of that capital would have been $200 billion greater. It was the ultimate lesson in sunk costs. The money was already spent. It was gone. Trying to get it back by investing more in the same losing proposition was the definition of irrationality. This powerful urge to chase our losses is rooted in one of the most fundamental principles of behavioral science, loss aversion. Pioneered by psychologists Daniel Kahneman and Amos Tversky, loss aversion describes our tendency to feel the pain of a loss approximately twice as strongly as we feel the pleasure of an equivalent gain. Losing $100 feels psychologically as painful as gaining $200 feels good. This asymmetry is hardwired into our evolutionary survival instincts. For our ancestors on the savannah, losing their dinner could mean starvation, while finding extra food was just a bonus. Our brains are designed to be exquisitely sensitive to threats and losses. In the stock market, this translates into a visceral, gut-wrenching feeling when we have to sell a stock for less than we paid. Booking a loss feels like a personal failure. It's an admission of being wrong. To avoid this pain, we do something deeply irrational. We hold on. We tell ourselves, it will come back. I'll sell when I get back to even. This is where loss aversion metastasizes into the sunk cost fallacy. The fallacy is the belief that you must continue a course of action because you have already invested resources in it. It's the person who sits through a terrible movie because they already paid for the ticket. It's the entrepreneur who keeps pouring money into a failing product line because they've already spent so much on its development. And it's the investor who holds a stock that is down 70%, whose business fundamentals have deteriorated, whose management is failing, simply because they don't want the red number in their portfolio to become a permanent realized loss on their record. Their decision is no longer about the future, it's about justifying the past. This is a recipe for financial ruin. To defeat this powerful psychological enemy, you need a weapon forged before the battle even begins. You need an applied mental model that takes the emotion out of the sell decision entirely. This model is the pre-mortem decision. Before you ever click the buy button on a new investment, you must take out a piece of paper or open a document, and you must write down, in clear, unambiguous terms, the conditions under which you will automatically sell it. This is not a target price to sell at a profit. This is a list of triggers that prove your original investment thesis is broken. A pre-mortem forces you to think about failure before you even start. What could go wrong with this company? What would cause me to change my mind? Your sell conditions must be specific and measurable. For example, if you're buying a pharmaceutical company based on a blockbuster drug patent, your sell condition might be, "I will sell if they lose the patent litigation." If you're buying a company because of its pristine balance sheet, your sell condition might be, "I will sell if the debt-to-equity ratio rises above 2.0 for 2 consecutive quarters." If you're buying a company because of its visionary founder, your sell condition might be, "I will sell if the founder leaves the company." By writing these rules down times in advance, when you are calm, rational, and objective, you create a contract with your future self. When one of those conditions is met, the decision is already made. You are no longer debating whether to sell, you are merely executing a predetermined plan. The emotional, pain-avoiding part of your brain is sidelined. It becomes a simple, logical process, not a gut-wrenching emotional struggle. This is the essence of professional risk management. You define your exit before you enter. The path of the 99% is the polar opposite. It is the path of the hopeful bag holder. This is the investor who buys a stock on a hot tip or a flimsy story. The stock plummets. Their original thesis, if they even had one, is clearly broken. The company has missed earnings for 6 straight quarters. Their main product has been rendered obsolete. Their debt is piling up. But the hopeful bag holder doesn't sell. Why? Because now they are down 80%. Their investment thesis has mutated. It is no longer, "This is a wonderful business with a bright future." It has become simply, "I just hope it comes back." Hope is not an investment strategy. It's a surrender. The hopeful bag holder's portfolio becomes a museum of past mistakes. It's filled with what professional investors call dead money, capital locked up in stagnant or declining assets, unable to be deployed into new, promising opportunities. They look at their portfolio and see a sea of red, each position a painful reminder of a bad decision. But instead of performing the necessary surgery to cut out the cancer and save the patient, they let it fester, hoping for a miracle. This is the behavior that leads to the infamous statistic that the average retail investor dramatically underperforms the market indices. They are not managing a portfolio. They are curating a collection of regrets. The direct financial connection of this behavior is devastatingly clear and mathematically undeniable. Get-evenitis is a disease that destroys capital with brutal efficiency. Let's look at the math of recovery. If a stock you own drops by 20%, you need a 25% gain just to get back to where you started. If a stock drops by 50%, a common occurrence in bear markets, your position needs to gain 100% to break even. And if your stock drops by a catastrophic 80%, it needs to gain 400% to get you back to your starting point. Now ask yourself, how many companies are capable of a 400% run in a reasonable amount of time? Very, very few. By holding on, by succumbing to get-evenitis, you are not being patient. You are demanding a miracle from a company that has already proven itself to be a failure. The financial consequence is twofold. First, the capital in that losing position is almost certainly going to continue to stagnate or decline. Second, and more importantly, that trapped capital is prevented from being used elsewhere. Let's say you have $10,000 in a stock that's down 80%. You have $2,000 left. You hold on, hoping for that 400% gain. Meanwhile, a fantastic new opportunity appears. A great business that you believe can double in the next 3 years. But you can't invest because your money is held hostage by your past mistake. A rational investor, using a pre-mortem plan, would have sold that stock much earlier, perhaps at a 20% loss. They would have preserved $8,000 of their capital. They could then take that $8,000 and invest it in the new promising opportunity. While the hopeful bag holder is praying for their $2,000 to someday get back to $10,000, the rational investor's $8,000 could grow to $16,000 or more. This is how wealth is built, not by avoiding losses. Losses are an inevitable part of investing, but by managing them intelligently. Cutting your losers is not an admission of failure. It is an act of strategic capital allocation. It is a declaration that your financial future is more important than your ego's connection to the past. It is a critical component of any intelligent investor's framework for building long-term wealth. We have now exorcised the ghost of holding losers. But there is another, perhaps more seductive and insidious siren song that wrecks portfolios: the temptation to sell your winners too early. This brings us to our third pillar, the winner's curse, and why cashing out early is a subtle but devastating form of financial self-sabotage. The greatest fortunes are not built by hitting a series of singles and doubles. They are built by finding a few truly extraordinary companies and having the fortitude to hold on to them for years, even decades, as they compound into life-changing investments. Selling one of these companies after it has merely doubled or tripled is like planting an oak tree and pulling it up when it's tall enough to be a Christmas tree. You get a small, immediate reward, but you sacrifice a future of magnificent, sheltering growth. For the perfect illustration of this principle, we turn to another one of Warren Buffett's most legendary investments, See's Candies. In 1972, Warren Buffett and his partner Charlie Munger, through Berkshire Hathaway, acquired See's Candies for $25 million. At the time, See's was a well-regarded but fairly small, family-owned chocolate company based in California. It was a good business, but not obviously a world beater. It earned about $4 million pre-tax, so they paid a reasonable but not ridiculously cheap price for it. Now imagine you are an investor in 1975, 3 years later. See's Candies has done well. The business's earnings have grown, and your investment is now worth, let's say, $50 million. You have doubled your money in 3 years. The voice of the winner's curse starts whispering in your ear. You've made a 100% return. That's incredible. Sell it. Lock in that profit before the market turns. You can't go broke taking a profit. This logic seems prudent. It seems safe. It seems smart. And it is the single biggest mistake an investor can make when they own a truly superior business. Thankfully, Buffett and Munger ignored that voice. They held on. They understood something profound about See's that went beyond the numbers on the balance sheet. They saw a business with a powerful, intangible asset, a deep and abiding brand loyalty in the minds of its customers, which gave it incredible pricing power. Every year they could raise the price of their chocolates a little bit, and customers would happily pay it because See's was associated with quality, nostalgia, and special occasions. This small, annual price increase, combined with modest volume growth, created a torrent of cash. The numbers are staggering. That little $25 million investment has, to date, generated over $2 billion in pre-tax earnings for Berkshire Hathaway. And most of that cash was not needed to be reinvested back into the candy business. It could be taken out and used to buy other wonderful businesses, like Coca-Cola or Apple. The See's Candies acquisition became a gusher of capital that funded the growth of the entire Berkshire empire for decades. Had Buffett sold after a few years for a $25 million profit, it would have been recorded as a successful investment. But it would have been a catastrophic error in the grand scheme of wealth creation. He would have sold his gusher for a pittance. He would have traded a multi-decade compounding machine for a quick, satisfying, but ultimately insignificant, short-term gain. This is the winner's curse in action, the tendency to cut our best-performing assets short, thereby preventing them from ever reaching their full, wealth-altering potential. The psychological machinery behind this phenomenon is complex, driven by a cocktail of biases. The first is the one we already know, anchoring. We are still anchored to our low purchase price. When a stock we bought at 20 goes to 40, our brain sees a 100% gain. We become fixated on that percentage return, not on the underlying value of the business. The gain itself becomes the story, overshadowing the far more important story of the company's future potential. But the deeper, more powerful force at play is a behavioral bias known as the disposition effect. This effect, documented in countless academic studies, is the clear statistical tendency for investors to sell assets that have increased in value, the winners, while holding on to assets that have decreased in value, the losers. We've already explored why we hold losers, loss aversion, but why do we sell winners? The primary driver is a different kind of aversion, regret aversion. When you are sitting on a nice paper profit, a new fear emerges, the fear that the stock will go down and you will give back your gains. The regret of watching a 100% gain shrink to a 50% gain feels more painful than the potential pleasure of that gain growing to 200%. To avoid that potential future regret, we take the safe option. We sell, we lock in the win. It provides a rush of satisfaction and validation. We were right, we beat the market. But this feeling of being right in the short term often comes at the expense of being truly wealthy in the long term. We are trading a potential fortune for a fleeting feeling of prudence. To counteract this destructive urge, you need a mental model that reframes the entire objective of investing. The legendary fund manager Peter Lynch provided the perfect analogy: watering the flowers and pulling the weeds. Think of your portfolio as a garden. You have some plants that are growing into magnificent fruit-bearing trees, your winners. And you have some that are sickly and attracting pests, your losers. The irrational investor, driven by the disposition effect, does the exact opposite of what any good gardener would do. They walk into their garden, cut their most beautiful, fragrant flowers to put in a vase, and then use the money they save on flower food to buy more fertilizer for their weeds. It's insane, yet it's precisely what most investors do. They sell their best-performing company, their flower, to lock in a gain, and then they often take that capital and average down on one of their losers, their weed, hoping to revive it. The applied mental model here is to become a true gardener. Your job is not to take profits. Your job is to constantly assess the health of every plant in your garden. When you look at a stock that has doubled or tripled, the question is not, should I sell to lock in the gain? The question is this flower still healthy and growing? You need a checklist. Is the company's competitive advantage, its moat, getting wider? Is its revenue and earnings growth still strong or even accelerating? Is the management team still executing its strategy flawlessly? Is the industry it operates in still favorable? If you can honestly answer yes to these questions, then the fact that the stock has already gone up is not a reason to sell. It is in fact evidence that your original thesis was correct, and that you should probably let it keep growing. You pull the weeds, the companies whose stories have deteriorated, and you let the flowers bloom, or even add more water to them by buying more. This simple analogy transforms your entire approach from short-term profit-taking to long-term wealth cultivation. The path of the 99% is the well-trodden road of the premature profit-taker. This individual constantly churns their portfolio, harvesting small gains. Their brokerage statement might show a lot of wins, but their net worth grows at a painfully slow pace. They buy a fantastic growth company. It doubles. They sell, feeling like a genius. They watch with a mix of pride and agony as that same company goes on to become a 10-bagger, then a 20-bagger. They got the hardest part right, identifying a great company early on. But they failed the test of patience. They snatched defeat from the jaws of victory. The premature profit-taker often justifies their actions with dangerous platitudes like, "You can't go broke taking a profit," or "I'm playing with the house's money now." This house's money concept is a particularly damaging mental accounting error. Once you have a gain, it's not the house's money. It's your truce money. Every dollar of it. And it deserves to be allocated to the place where it can grow the fastest. By taking it out of your best-performing asset and putting it into a mediocre one, You are actively moving your capital from a high-return environment to a lower-return one. You are systematically culling your champions and breeding your laggards. This is a formula for ensuring your portfolio will never achieve spectacular returns. It will be doomed to mediocrity. The direct financial connection of this behavior is the difference between arithmetic and geometric growth. It is the magic and the tragedy of compounding. Let's run the numbers. Imagine two investors, Investor A, the gardener, and Investor B, the profit taker. Both are skilled and lucky enough to invest $10,000 into the next great technology company. The company is a huge success and the stock goes up by a factor of 20 over 10 years, a 20-bagger. Investor B, the profit taker, sells after the stock doubles to $20,000. He makes a $10,000 profit. He feels great. He then takes his $20,000 and reinvests it in the general market, which earns a solid but not spectacular 8% per year for the remaining 9 years. After 10 years, his initial $10,000 has turned into roughly $40,000. A respectable outcome. Now consider Investor A, the gardener. She does her homework every year. She sees the company's moat widening, its profits soaring. She resists the urge to sell. She does nothing. She just holds on. After 10 years, her initial $10,000 investment is worth $200,000. By doing nothing, by simply letting her flower grow, she has achieved a result that is 5 times better than the active, prudent profit taker. The financial cost of selling that winner early wasn't just the future gains she would have missed. It was the life-altering power of compounding that was sacrificed for the small comfort of a short-term gain. This is the mathematical proof that true wealth in long-term investing is created not by being clever, but by being patient. It is the reward for overcoming the winner's curse and developing a true CEO mindset focused on long-term value creation, not short-term profit-taking. We have now dismantled the two great emotional pillars of bad decision-making, the refusal to sell losers and the eagerness to sell winners. Both are rooted in an emotional attachment to the past, to the price you paid. The antidote, then, must be a system that forces you into the present, a mental framework that compels you to make decisions based only on the facts of today and the possibilities of tomorrow. This brings us to our fourth and most crucial pillar, the daily zero-base audit. This is Warren Buffett's core mental framework for pure, unadulterated rationality. It is the practical application, the how-to, that ties all these concepts together. The anecdote that best captures this mindset is not about a single purchase, but about a long-term holding, the Washington Post. In the early 1970s, during a severe bear market, the market was gripped by fear. Stock prices were plummeting. Buffett, ever the contrarian, went shopping. He identified the Washington Post Company as a phenomenal business with a powerful newspaper franchise, a local monopoly that was like an unregulated toll bridge for commerce in the nation's capital. And it was selling for a ridiculously cheap price. In 1973, he invested about $11 million to buy a large stake in the company. That purchase is now the stuff of legend. But the real lesson is not in the buying, it's in the holding. That $11 million investment grew over the next 30 years to be worth over $1 billion. It was more than 100-bagger. Why did Buffett hold on for so long? The answer is that every single day, for 30 years, the Washington Post had to re-earn its place in Berkshire Hathaway's portfolio. Buffett did not hold it because he bought it cheap. He did not hold it out of loyalty to the Graham family who ran it, though he admired them greatly. He held it because on almost any given day during that period, if you had asked him the question, if you didn't own the Post and you had its market value in cash, would you buy it today? His answer would have been yes. He was mentally rebuying the stock every single day. He was subjecting it to a constant, ruthless, zero-base audit. The past, his brilliant decision in 1973, was irrelevant. All that mattered was the present valuation and the future prospects. There were likely days or even years when the answer to that question might have been no, and if that no had persisted, he would have sold. The holding of an asset was not a passive state for Buffett. It was an active, daily decision to commit capital. This continuous, forward-looking evaluation is the engine of rational portfolio management. This mental model is a direct application of a management concept called zero-based budgeting, combined with a fierce awareness of opportunity cost. In traditional budgeting, a department manager might say, "Last year my budget was $100,000, so this year I need $105,000." They are anchoring to the past. In zero-based budgeting, the manager starts from zero. They have to justify every single dollar they want to spend, from the first to the last. They have to explain why spending that dollar on their project is a better use of company funds than any other alternative. Buffett applies this same ruthless logic to his portfolio. Every stock starts the day with a value of zero in his mind. It must then justify its entire market valuation as being the best possible use of that capital for Berkshire. This directly combats a pervasive cognitive bias called opportunity cost neglect. Most of us don't actively think about what else we could be doing with our money. The money invested in a stock feels abstract, locked away. We don't feel the pain of the opportunities we are missing by keeping it there. The zero-base audit forces you to confront this head-on. It makes the opportunity cost tangible and immediate. Your stock holding is no longer just a line on a statement. It is a pile of cash that is choosing every second not to be invested in anything else in the entire world. Is that truly the best choice? This framework forces you to answer that question over and over again. So how do we as individual investors apply this powerful CEO mindset? We formalize it into a repeatable process. We call it the cash equivalent question. I want you to schedule a time, perhaps every Sunday afternoon, to run this audit on your portfolio. No emotions, just business. Go through your holdings one by one. For each position, perform these 3 steps. Step 1. Identify the current market value. For example, you own 200 shares of company ABC at $100 a share. Your position is worth $20,000. Step 2. Frame the question. You must say it out loud or write it down to make it real. I am holding $20,000 in cash right now. Of all the thousands of investment opportunities available to me on this planet, stocks, bonds, real estate, paying down my mortgage, investing in my own business, is buying 200 shares of company ABC at $100 per share the single best use of this capital to achieve my long-term financial goals? Step 3. Answer honestly. A yes must be a resounding, confident yes. It means you are excited to own the business at its current price. If the answer is an enthusiastic yes, then you continue to hold. But if the answer is anything else, a maybe, a probably not, or a definitive no, then you have a clear mandate to act. You must sell the position and redeploy that capital to the idea that would have elicited a resounding yes. This process is the ultimate tool for achieving financial freedom because it ensures your capital is always working for you in its highest and best use, not simply resting where it happened to land based on a past decision. The antithesis of this disciplined approach is what defines the 99%, the inertia portfolio. This is the portfolio as a dusty attic, a collection of things acquired over the years and then forgotten. The owner suffers from a powerful status quo bias, the preference for things to stay the same. Making a decision to sell is hard. It requires research, conviction, and action. Doing nothing is easy. The inertia portfolio is the path of least resistance. It contains a stock bought 10 years ago on a friend's tip that has done nothing. It contains shares from a former employer that are just sitting there. It contains a hot stock from a few years back that has since cooled off but hasn't collapsed. There is no active management, no strategic thought. It is a financial graveyard of past decisions. The owner might justify their inaction by saying they are a long-term investor, but they are confusing patience with neglect. Patience is actively choosing to hold a great business after careful reevaluation. Neglect is holding something simply because you already own it. The inertia portfolio is not a tool for building wealth. It is a museum of what could have been. It is the abdication of your role as the CEO of your own financial life. The direct financial connection here is the profound difference between a managed portfolio and a drifting portfolio. Let's quantify the impact of the annual zero-base audit. Imagine two identical $100,000 portfolios. Portfolio A is the inertia portfolio. It is set up once and then left to drift for a decade. Portfolio B is the CEO portfolio. Once a year, the owner performs the ruthless cash equivalent question on every holding. Let's say, through this process, they make one or two changes a year, selling a company whose prospects have dimmed and reallocating that capital to a company with a brighter future, or even just to a low-cost index fund. They are not day trading. They are making strategic long-term adjustments. Over a decade, which portfolio do you think will perform better? The answer is clear. The CEO portfolio, by consistently pruning its weakest holdings and reallocating capital to its strongest convictions, will almost certainly generate superior returns. It benefits from a constant process of optimization. It cuts the C students and gives their resources to the A students. The inertia portfolio, by contrast, will be dragged down by its laggards. Its past winners may mature and stagnate, but they will never be replaced. The difference in returns may seem small in any given year, but over 10, 20, or 30 years, the compounding effect of these small, rational decisions creates a massive gap in final wealth. This is the tangible financial power of replacing inertia with intention, and it is the key to transforming your collection of stocks into a true, dynamic engine for portfolio growth. We have now journeyed through the core psychology and the practical application of this powerful investment philosophy. We have learned to break the anchor of the past, to overcome the pain of selling losers, to resist the temptation of selling winners, and to apply the ruthless daily logic of the zero-base audit. Our fifth and final pillar is about synthesis. It's about taking these individual tools and forging them into a coherent system. This is where we become the architect of the future, building a portfolio that is structurally immune to the emotional mistakes of the past. The ultimate anecdote for this pillar is not a single investment, but the entire, living, breathing entity of Berkshire Hathaway itself. Berkshire is not a static collection of assets. It is the physical manifestation of a rational capital allocation system. Warren Buffett is not just a stock picker, he is the architect of this system. Watch his actions over the years. During the height of the COVID-19 pandemic, he sold Berkshire's entire holdings in the major airlines. Why? Because the thesis had changed. The future of air travel became uncertain. Applying the cash equivalent question, he could no longer say that billions of dollars invested in airlines was the absolute best use of that capital. So he sold, taking a loss. He pulled the weeds. Conversely, in recent years, he has made a massive, multi-billion-dollar investment in Japanese trading houses and has repeatedly added to his enormous position in Apple. These were not emotional decisions, they were the output of his system, identifying what he believed to be the best opportunities for future returns. Even his trimming of the Apple position, selling shares worth billions, was not a sign of panic. It was a rational portfolio management decision, likely based on valuation and the desire to manage the position's enormous size within the portfolio. Berkshire Hathaway itself is the ultimate proof of the system. It began as a failing textile mill, a sunk cost. A lesser mind would have remained anchored to that past. But Buffett transformed it. He used it as a shell, a vehicle, and began allocating its capital rationally. He starved the bad business and fed the good ones. The history of Berkshire is a history of shedding old skins, textiles, department stores, a local newspaper, and growing new, stronger ones, insurance, railroads, technology. It is a masterclass in dynamic, forward-looking, executive decision-making. It is the blueprint for how to build an empire, not by being sentimental about the past, but by being relentlessly optimistic and rational about the future. This brings us to a crucial psychological distinction: the difference between systems thinking and goal-oriented thinking. A goal-oriented investor says, "My goal is to get back to even on this stock." This is a fragile state. What if the stock never gets back to even? You are stuck, a prisoner of your goal. A systems-thinking investor says, "My system is to apply the cash equivalent question to all my holdings every week and reallocate capital from the least promising to the most promising." This is a robust and anti-fragile system. The system doesn't care about any single stock. It is a process for continuous improvement. By focusing on building a great system, you achieve the desired goals as a natural byproduct. The goal should not be to save a bad investment. The goal should be to build a great portfolio. This requires a shift in identity. You are not a stock picker. You are not a trader. You are the chief capital allocator of your family's wealth. You are the CEO of a financial enterprise. This identity shift is the cornerstone of achieving true financial independence, because it places the power and the responsibility for the process, not the outcome of any single bet, squarely on your shoulders. To put this all into practice, you need an applied mental model to architect your own system. I call this the Portfolio Constitution. This is a one-page document, your personal investment manifesto, that will guide you through the storms of market volatility and the temptations of your own emotional biases. Your constitution should have 3 sections. Section 1, your core principles. Here you write down your fundamental beliefs. For example, I am a long-term owner of excellent businesses, not a renter of stocks. My purchase price is irrelevant to a sell decision. I will only invest in businesses I can understand. These are your guiding stars. Section 2, your process. This is the how. It should explicitly state your rules. For example, I will perform the cash equivalent question on my entire portfolio on the first Sunday of every month. I will write a pre-mortem decision with specific sell criteria before I purchase any new stock. I will not make any investment decision based on a news headline or a hot tip. This section operationalizes your principles. Section 3, your long-term mission. Why are you doing this? What is the goal? To achieve financial independence by age 55 so I can travel the world. To build enough wealth to pay for my children's education in cash. To create a legacy of financial security for my family. This mission is your emotional anchor in the best sense of the word. When fear and greed are swirling, your constitution is the bedrock you stand on. It is the unemotional, rational CEO version of you, captured on paper, ready to give orders to the emotional, impulsive version of you that panics during a market crash. The path of the 99%, the antithesis of the architect, is the gambler's mindset. The gambler treats the stock market like a casino. They chase meme stocks, they buy complicated derivatives they don't understand, and their decisions are driven by the twin emotions of extreme greed and paralyzing fear. Their portfolio has no rhyme or reason. It is a chaotic collection of bets, a series of lottery tickets. They are addicted to the thrill of the action, the dopamine hit of a quick win. They are not building a business, they are placing wagers. When they win, they feel invincible, attributing it to their own genius. When they lose, they blame the rigged market or bad luck. They have no system, no principles, no constitution. They are adrift in a sea of noise, and as countless studies have shown, they are destined for long-term underperformance. The gambler's mindset is the abdication of control. The architect's mindset is the embodiment of it. This is the fundamental choice every retail investor must make. Will you be a gambler, or will you be an architect? The direct financial connection of this final pillar is the ultimate outcome of your entire investment journey. It is the difference between a life of financial anxiety and a life of financial freedom. Let's chart the course of 2 investors over 30 years, both starting with $50,000. Investor A is the gambler. They chase trends, hold their losers too long, and sell their winners too early. They get caught up in bubbles and panic sell in crashes. Their portfolio churns, and after 30 years of stress and activity, Their compounded annual return is a meager 4%, barely keeping up with inflation. Their $50,000 becomes about $162,000. Investor B is the architect. They build a system. They create their constitution. They ruthlessly apply the cash equivalent question. They cut their weeds and water their flowers. They make mistakes, but their system corrects them. Their compounded annual return is a solid, achievable 10%. After 30 years, their $50,000 becomes approximately $872,000. The difference is not small. It is life-changing. It is the difference between a modest supplement to Social Security and a comfortable, secure retirement. This is the tangible, quantifiable result of thinking and acting like a true capital allocator. This is the path from being a stock market beginner to truly beating the market. It is the ultimate financial education, the real secret to building wealth and achieving the financial independence you deserve. You have just spent this time fundamentally rewiring the way your brain interacts with the market. You now possess the mental key to unlock yourself from the prison of past decisions. You have the tool to sever the emotional chain that connects you to your purchase price, freeing you to make purely rational, forward-looking decisions about your capital. This is more than just a stock tip. It is a permanent upgrade to your entire financial operating system. You now know how to avoid the trap of get-even-itis and how to resist the siren song of premature profit-taking. You have the framework, the zero-base audit, that the world's greatest investors use to ensure their money is always working its hardest for them. You have acquired a powerful weapon, but a weapon is only one part of an arsenal. Applying this zero-base audit to a single stock is one thing. Understanding how it fits into a larger system of capital allocation, how Buffett decides between buying more of an old favorite versus initiating a completely new position, how he thinks about asset allocation across dozens of businesses, that's a different level of strategic thinking. It's the difference between knowing how to aim and knowing which battles to fight. The video that is now appearing on your screen is the next piece of that puzzle. It is the bridge between a single, powerful decision-making tool and a comprehensive wealth-building strategy. It is about building the machine, not just polishing one of its gears. Average investors are forever haunted by their past mistakes. The truly successful are architects of the future. The choice to continue this journey, to click on that video, is not about watching more content. It is a decision about who you want to become. Complete your mental arsenal. The next step in your transformation begins now.